Chinese tech stocks have been on an absolutely wild ride. At one point, you could see KWEB, which is an ETF for Chinese internet stocks, was up 100% in about a year. Then the following year, it lost about 80% of its value. Last year, it actually treaded water, performed better than US stocks. And in the last 2 months, you've seen about 60-70% rally. You look at a stock like Alibaba, up around 70% in the last 2 months, causing investors to wonder, will it last? Why is it up so significantly? I'm going to talk about those questions and more in this video. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, I do appreciate that subscribe button. So let's understand, well, what's going on? Why are you even seeing this bounce? Well, part of it's because of sentiment. I mean, just, in the last year or so, you've seen investors say, hey, China's uninvestable. This is despite the fact that the phone you're using is probably produced, manufactured in China. A lot of the clothing you're wearing, a lot of the widgets that you have around your house, your home, probably manufactured in China. But a lot of folks saying, hey, it was uninvestable. So that was a sentiment, I'd say close to the bottom in sentiment in terms of China saying, hey, this is the second largest economy in the world. But due to the uncertainty with the CCP, you just couldn't invest in it. Now, the firm JP Morgan subsequently said, oh, yeah, that report was that uninvestable report, uninvestable call was published in error. But clearly that is what they were thinking. Now, why have you seen this turn in Chinese internet stocks? Well, part of it is a U-turn in their own policies with COVID. You saw protests, and they previously were at zero tolerance. Now they do a complete 180, saying you're on your own. You even see their mouthpieces talking about how they're entering in a new phase of COVID responses. Clearly will help the Chinese economy. Another core aspect is their tolerance with property developers that were over-levered. Previously, they had a 3 red line approach. Effectively, to summarize it, is saying, hey, you have so much debt, you can't cross certain levels. If you cross the levels, you got to liquidate your properties to get below that leverage requirement. Whenever you have forced selling, it creates problems for the ecosystem. So if you have a very levered property developer with a huge investment portfolio trying to sell their illiquid investments to meet the leverage requirements, that's going to create more problems for you. And so, yes, it does send the signal, hey, we don't want this going further out of control, but it should be acknowledged that China is facing this sort of property bubble crisis that is popping. They're going through it. And they're saying, oh, we're taking our foot off the pedal in terms of how restrictive we're going to be. And that's what they're saying. We're going to ease the debt caps. We're going to ease the limitations we put on some of these companies that were putting them in sort of forced liquidation mode. They're going to, postpone deadlines for at least 6 months, as they sort of work through this, recognizing, hey, we sent the signal, but we also don't want to cause, a depression as you have a lot of forced selling spiraling with the property developers. Hey, let's make sure this is a manageable crisis, or try to, handle it with a smooth transition. Another key aspect is you see the People's Bank of China talking about wanting to grow the economy, doing what it takes to grow the economy, moving from a restrictive policy over the last few years to a more easy policy over the last year or so. And you've seen that, more of an easy policy last year, lowering rates, some sort of stimulus. You're seeing more of that this year, at least that's expected. A lot of folks like to talk about don't fight the Fed. That would be the Federal Reserve in the US. You could say the same thing applies in China with the People's Bank of China. Don't fight the People's Bank of China. If you're looking at Chinese equities, you're talking about promoting further growth. Generally, when you see the central bank start easing, it can lead to multi-year gains, multi-year growth with the economy, and with potentially, risk assets as well, like Chinese stocks. So that is an important data point to consider. As a result of, I'd say, all these different data points, you have seen a significant rally in stocks like Alibaba and Tencent posting very strong starts to the year. A lot of folks are saying, hey, the regulation of these platform companies, which has been a key concern, they're saying it's basically finished. That's the viewpoint, that you've had a lot of tough regulations. Now it's about, hey, we want to make sure the economy grows. We want to make sure our best companies are still performing, and we don't want to crush them to death. And that is the Alibaba, the Tencents of the world. Now you're seeing additional data points that Jack Ma, he's ceding control of Ant Financial. What does that mean? Potentially an Ant IPO reboot. A lot of folks were very excited about that in the last few years. So for some context, when you look at Ant Financial, it's changed a lot, and it's unclear exactly what does their business look like today in terms of their financials. It's still a private company, but when they were going to IPO, you had several different pieces, including their asset management business, a loan platform, an online payments platform managing literally trillions of dollars in payment processing, a key part of the Chinese economy, and also insurance for tens of millions of individuals. So when you looked at Ant, it was just this financial behemoth in China. And you had Jack Ma sort of running his mouth saying, hey, there's a bunch of old men trying to regulate us. That caused him to get the boot, and he disappeared. And then he goes, okay, I'm getting out of Dodge. And he was in Japan. He's in Thailand. He goes, okay, I don't want that to happen again. So now he's ceding control of Ant Financial. And does that mean you potentially see this new IPO? He'll still have something like a 6%, voting stake. It just won't be that 50% plus stake that he had previously. So looking at Ant Financial now, it's tough to say, what exactly the valuation will come at. Previously, right before IPO, it was something like $250 billion valuation. Now you see private market valuations anywhere from like 70 billion to 150 billion. Now, given that Alibaba still owns about a third in Ant Group or Ant Financial, that, if you assume that $100 billion private market valuation, it's unclear if that's the right amount. It could be way off, but that could be around 10% of Alibaba alone. And in my prior videos, and as I've called out Alibaba being quite cheap, I did a video literally in November as this, started to rally, talking about a turnaround. I wasn't even including their stake in Ant Group as potentially why the stock was so cheap. So that is an important point to consider. Okay, so what happens to Alibaba stock? What happens to Chinese tech stocks from here? Well, first, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. I also recently launched 2 new investment courses for investors wanting to learn about financial statement analysis as well as how to value stocks. And full disclosure, this is not financial advice. So what are my key thoughts on Chinese tech stocks, on Alibaba? My detailed thoughts on Alibaba, I would recommend you check out my last video on Alibaba. The short summary, however, is that I still think it's cheap, even though it's rallied significantly. I previously was calling out how it's trading around 10 times free cash flow. Now it's up a bit, but it's still, some sort of teens multiple when you look at the business, and it still has a lot of cash and it has investments like Ant Group. So I'd still put it in the cheap category and the potential to compound long term. That said, I do want to recognize that a lot of investors get hot to trot when they see something rip higher, over a month or two. Oh, I want to get on board, that type of attitude. My personal attitude is I like to buy things when they dip. I like to buy great companies when they're on sale. That's my own personal approach. Everyone has their own personal journey. But when I see something that rips so significantly in a month or two, it makes me a little cautious that it becomes overbought and then you might see it sell off or trim a little bit. So it wouldn't surprise me to see that outcome. Do I still own Alibaba stock? Do I still own a basket of Chinese stocks? Yes, I personally do in my portfolio. I call that out to my subscribers at unrivaledinvesting.com. Alibaba is not my largest position in my Chinese basket, but I do have a couple of different positions where I'm sort of saying, hey, how do I make sure, let's say they're able to buy back lots of stock or position themselves to benefit longer term. So that's, it's a combination of not only growth, but also valuation. You want to factor in these different components as you think about your investment returns, not only the growth element, but also, am I getting a compelling valuation? And this is such a super important point for investors to consider because it's often overlooked. And I mentioned it briefly already about don't fight the Fed or don't fight the People's Bank of China if you're investing in Chinese stocks, which is this key aspect. You look at several hedge fund managers managing billions of dollars. They themselves have become billionaires. And I think there's almost a simplistic lesson you can see from their behavior, which is they themselves just align themselves with that key mantra of don't fight the Fed. And, David Tepper, Stanley Druckenmiller, David Tepper made a fortune in the great financial crisis when he just loaded up on bank stocks because he's like, oh, the Federal Reserve is clearly going to make this work. They're clearly going to print a ton of money and this is going to work. And so he made a ton of money. Now, how is he positioning himself? Well, he trimmed a lot of stocks because he said, hey, the Fed's tightening. He's less bullish. I mean, the Fed has been cueing this. When you have one of the largest fish in the aquarium telling you how things are going to, how things will occur, it's worthwhile for you to pay attention to it, whether or not it's easy or restrictive monetary policies. Right now, I look at US stocks and I say, hey, this is still in the restrictive policies. A lot of folks are getting excited because, oh, maybe down the line, maybe in a few months from now, you'll start seeing more easy policies. But I think you'll see the easy policies only after you see a tough economic outlook in the US, where the central bank in the US goes, oh, okay, it's okay for us to lower rates. That's one situation. In China, you're already in that. You've already seen a lot of that pain with the property crisis. So you have the easing from the central bank in China. So that's part of the reason why you have this tailwind. I personally look at it, and it wouldn't surprise me to, as I consider Chinese tech stocks, it wouldn't surprise me to think that they could have a multi-year bull market looking at some of these Chinese tech stocks. That's personally how I'm positioned. That said, the geopolitical card, looking at Taiwan, that's always an uncertainty. So that's the reason why I can't make it, let's say, 30% of my portfolio on a cost basis. I look at this and I say, hey, I've allocated around 10%, give or take, where I'm saying this is a little bit more, because it's moved up a bit in the last 2 months, as I've already called out. So I have this allocated to it where there's parts of it with the CCP and geopolitical risks that I don't want to, I don't want to overly lean on, just because you don't want to wake up and say, oh, now there's an invasion in Taiwan or something like that. So that I do have an allocation. It's the second largest economy in the world. Once again, most of the goods that people get, manufactured in China. So it's an important data point to consider. A lot of the goods that people get manufactured in China. So I look at that and saying, hey, now you have the People's Bank of China aligned. Valuations are still pretty darn cheap or reasonable. So I continue to own my basket of Chinese stocks, and I'll update my subscribers at unrivaledinvesting.com if I do buy a little bit more or trim it in the future. And if you enjoyed this video talking about Alibaba stock as well as Chinese tech stocks, the recent rally, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.